27th of February. This is microeconomics. And you are the only thing between me and spring break. All right, let's play some short true-false questions with perfect competition. And see if that triggers any other thoughts on your side. And part of this I want to draw graphs for, and part of it I want you to just think through the words. Because in many cases on the exam, the questions will just be words, no graphs. So you've got to be able to visualize the graph. Okay? So, if the price, this is all for perfect competition. If the price falls below the break-even point, what are the implications? Let's try it that way. What are the implications for the short run and the long run? This is for a perfect competitive firm. And a warning, our author in this textbook, Schiller, when he uses the term competitive firm, he is talking about a perfect competitive, as we have defined it. So if price falls below the break-even point, what's going on in this company's life? They're losing money in the short run, long run?
They're bringing enough money to where they can pay variable costs.
Yeah.
But they can't pay long-term costs, so they can only stay open in the short run.
Okay.
Unless
I like both your answers. It's pretty good. Let's see if I can get this on here. Let me go over here. We're describing a situation average total cost, average variable cost, and price falls below the break-even point. Where's the break-even point on that graph?
Bottom of the average total cost.
Bottom of the average total cost curve. That's the break-even point. So the price falls below that. Let's say first at D1, if that's their price. What does that mean for them? First, they're losing money because they're not covering all their costs. But what does this mean in the short run?
They can still cover variable costs.
They're still covering, and I'm going to have to draw the marginal cost curve in so we know where they're at, right? They're always on the marginal cost curve. Alpha is always on the marginal cost curve. So they're here at alpha 1. They're not covering their total costs, but they're covering their variable costs. So they remain open in the short run. Good. But in the long run, they're going to have to go out of business. Okay? We got the difference there? What do we call this point right here? The shutdown point. Does that mean if the price goes down to there, D2, they need to shut down? Only if it goes below that. They can remain open here. I got that drawn poorly. They can remain open here in the short run, but still in the long run, they're still losing money. Okay? What will be the impact on the industry supply curve if the price is at D1 or D2?
It'll probably shift to the left as more competitors exit the firm because they can.
Certainly in the long run, these folks are going out of business, right? So at least in the long run, that supply curve is going to shift back over to the left with a decrease in the number of sellers. Okay? Whether that would happen in the short run or not, it depends on how short the run is for different firms. If you're this company, what determines whether or not you can survive in the short run?
Just your pay.
Not just your price, what else? You're losing money, you ain't making enough money to cover all of your costs, but you're covering your variable costs.
Whenever you're,
Your fixed costs?
yeah,
Well, you're not quite making enough money to cover your fixed costs, so how long are you gonna last?
until those are due.
Until your bills are due, or if you got money in the bank,
Until that.
you're gonna last as long as the money in the bank lasts. So we use a term in economics, we call it deep pockets. Companies that have deep pockets have lots of cash. And they can survive in the short run, and then when the others get out of business, they got less competition, okay? So sometimes we say, what's this gonna do to the firm? Well, it depends on how deep their pockets are. And to translate that into the real world, an awful lot of small businesses may go for 6 months or a year or 2 years losing money. And the owners will be pulling money out of their own savings, trying to keep it alive. And if he's got enough money, maybe he can survive and eventually grow. But if not, you can lose everything you own. Okay? So, if price falls below the break-even point, a firm should get out of business, true or false?
Depends.
False? Why?
Because
Huh?
because they can cover their costs for a little bit in the short.
It's not always true, it's not, so it's, if it's not always true, it's false. If the price falls below break-even, do they have to get out of business? Not in the short run if they're covering their variable costs. So that makes the statement false. Let me say that again. If you read a statement, true or false, and it's not always true, mark it false. Okay? If price falls below the shutdown point, a firm is going to get out of business. Always true, okay? Unless he's stupid, in which case he should have known better. No problem. Okay? One more time. If marginal revenue is less than marginal cost, should the firm produce more or less or the same amount?
Yes.
Marginal revenue is less than marginal cost. You've got to be able to see that in a graph. When is that happening? And so if you imagine the graph with just the marginal revenue curve, which is the same as the demand curve, and we draw the marginal cost curve normally like that with an upward slope, where on that graph is marginal revenue less than marginal cost? Anywhere to the right of this point. Okay? When you get out there, marginal, for each unit that you're looking at, when you read up, the marginal revenue is less than the marginal cost curve. Okay? Do they need to produce more, less, or leave it the same? They need to move where?
To the left.
They need to move back to alpha. So if they're out in here somewhere, they need to reduce production, they need to produce less. Getting comfortable with how we're going to read some of these questions. If there's 50 questions on this test, and you finish this test in less than 50 minutes, you should be a little bit concerned, because you've got to read those questions very, very slowly and carefully and parse them into pieces.
When you're producing at margins like that, where your marginal revenue is less than your marginal cost, that's called loss profit, right?
Sometimes we call it loss leaders. Sometimes we, and it may be a short run tactic to try to, and I might do this with one product to bring everybody in the store, but all my other stuff has got plenty of margin in it, and I'll take a loss on some of those leaders to bring people in order to sell more of the other stuff. Okay. Suppose the marginal cost curve is constant. What does that mean first?
Demand is,
There's no demand shown, just cost. Huh?
Perfect competition.
No, because that would be a demand curve,
for every one you produce, the price is constant.
not the price. Price comes from demand.
Well, the cost.
The cost is constant. Every time I produce one more deer head for my taxidermy,
The cost
it's the
is-
same cost as the next one, as the last one, and so on and on and on, okay? If that's true, and for most businesses, that is true over a good bit of their production range, and my demand curve is here, with a negative slope, what happens if I'm operating out here?
We're doing profits.
You're
No,
losing- you're
but I haven't shown you yet, your marginal revenue's over here. You're losing profit, but just in terms of what we've done in the course to this point. If I said the firm was operating with a negative slope curve and they were operating here, what could you tell me?
You're losing money.
When the marginal cost curve is flat, where's the average total cost curve?
It's flat.
It's the same thing. When marginal is flat, it's the same as the average. So at this point, what's going on?
You're covering your total costs.
It's another word for that.
Breaking even.
You are breaking even. Let's put some numbers up there just for greens. 100 units, $6 price. I want to calculate my total revenue, my total cost, and my profit. How do I calculate total revenue?
Your output times your price.
Price times quantity. $6 each times 100. $600, okay? How do I calculate total cost?
The variable cost times your,
Not variable.
Total cost times.
Average total cost, okay? Average total cost times quantity, which would be the same thing. How much profit am I making?
You're not making an economic profit.
Good, that's part of the answer. Zero economic profit.
You're making an economic profit.
I'm making a normal rate of return accounting profit. Is that sounding familiar, comfortable? My economic profit is zero, but I'm covering all my costs, remember? Average total cost. Covering all my costs. One of my costs in economics is a normal rate of return profit. So, am I going to go out of business here? No. You doing okay with that so far? Bless you. The whole trick in what I did just now was when I drew the marginal cost curve as flat, you had to remember, oh, that's also the average total cost curve. Or if I had labeled it this way, this is the average total cost curve. What did you need to know? Oh, it's also the marginal cost curve. Question, somebody? Yeah.
So would you want to produce to the left of that point to optimize profits?
I would always be looking for alpha, which means I need to know both the marginal revenue and the marginal cost. What we're going to do on the next go-round is we're going to not make the demand curve flat, we're going to make it negative slope. When we do that, it's no longer the same thing as the marginal revenue. And in fact, if you go out here, whatever this intercept is, that's 100, go out halfway to 50, start at the same place, that's going to be their marginal revenue curve. So now when their marginal cost curve is here, this is alpha. Alpha tells us quantity, end up with the demand curve for price, and live happily ever after. Is this company profitable?
You need the average.
I need the average total cost curve. If the average total cost curve is out here, they're losing a fanny. But if it's down here somewhere, they're in pretty good shape. Okay? We'll go into this negative slope demand curve in a bit. And in fact, I think the next test will incorporate that. But more stuff about monopolistic competition. Hang on. If you saw this graph, what would you say?
That you're going to be losing money because
Always?
the marginal cost curve always intersects at the lowest point. So
What do I know? I know that if the demand curve is flat, what? It's also the marginal revenue curve, okay? And if the marginal cost curve is flat, what do I know?
You know the.
It's the average total cost curve. Right? Well, demand, average total cost curve, demand, what's another term we could put here for the demand curve?
Price.
Price, the price line. And what's going on at every single level of output?
You're losing.
I'm losing money. My average cost is greater than my price. What should this firm do? Go fishing. Get out of business. Forget it. Okay? Where does this firm maximize its profit?
Anywhere at all. Doesn't really matter.
Maximize.
As far as they can output.
As far as they can produce, maximum output. Because why? This is also marginal revenue. So every time they sell another unit, they make a profit on it, as many as they can produce. What should you do here? Produce like crazy, build another factory, extend your barn out, I don't know, keep making the damn stuff, hire some folks, and as long as you can keep doing this, the more you produce, the more profit you earn. Just some unusually shaped cost curve. Average total cost, average variable cost, marginal cost. Show this perfect competitor in long-run equilibrium. What would you draw in there? The demand curve, and where would you draw the demand curve?
You said it perfect.
Anywhere I draw it, I'm going to have an alpha.
You want to put it at the
Long-run equilibrium.
break-even point.
The demand curve would be here. Just tangent, I'm going to put LR, to the average total cost curve. Why is that a long-run equilibrium?
Because they're doing the bare minimum to stay open in the long run.
This is their alpha, right? Because this is marginal revenue. Marginal revenue equals marginal cost. This is alpha. This is the right quantity. How much profit are they making there?
No, they're not. They're just.
They are breaking even, so elaborate. How much profit are they making there?
Depends on what you're asking. They're making an accounting profit. but
They're
not
making a normal return accounting profit. And how much economic profit?
No, they're not.
Zero.
More to invest.
So, are they okay to stay in business? Yes. Are there more competitors going to come into the industry?
Probably.
No?
What makes competitors come in?
Economic.
Economic profit.
Yeah.
You see what I'm saying? Good. So this is long-run equilibrium for the industry. Every firm would look like this. Where's the marginal cost curve to go with that? Okay, let's make this the minimum point. Where's the marginal cost curve? When average cost is falling, marginal cost is below it. And when it starts going up, marginal cost is above it. So I'm going to draw the marginal cost curve kind of like this. Okay? If that's my demand curve,